Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on investing in mutual funds. What is a mutual fund? A mutual fund is a type of investment created with the purpose of pooling funds from various investors to invest in securities like bonds, money market instruments, and stocks. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its trust deeds. Mutual funds allow subscribers to build diverse investment portfolios without buying individual stocks or bonds. A mutual fund can be a proper place to begin if you want to save money for retirement or other goals. How do mutual funds work? Mutual funds are set up and managed by registered companies with the Securities and Exchange Commission (SEC). Mutual funds are operated by professional portfolio managers who allocate the fund's assets to earn income for the subscribers or investors. When you invest in a mutual fund, you purchase units or shares in the fund, either through the fund manager, stockbroker, or other investment channels. Each unit purchased represents your percentage of ownership of all the investments in the mutual fund's portfolio. How can you make money from investing in mutual funds? 1. If the funds sell securities during the year and profit from the sale, the profit can be distributed in the form of dividend to the subscribers either biannually or annually. You can elect to reinvest your dividend in the fund. 2. If the net asset value, which is also the market value of the mutual funds, goes up, your holdings will increase. You can unlock your return by selling some or all your units in the funds. Main types of mutual funds. Open-end funds. These are funds that continually issue shares as they do not have a limit to the number of shares they can offer. When an investor purchases shares in an open-end fund, the fund issues those shares, and when a subscriber sells shares, which is redemption, they are repurchased by the fund. The fund pays the investor using cash on hand or may have to sell some of its investments to pay the investor. Shares of open-end funds are purchased and sold directly from the fund at a price per share that is based on the value of the fund's underlying securities. On each trading day, typically at the end of the day, the net asset value (NAV) is calculated by dividing the market value of the fund's asset less expenses by the number of shares held by investors. Closed-ended funds. These are funds that have fixed number of shares that are sold at the initial public offering (IPO). At the end of the IPO, the fund closes the sale of its shares to the public and is traded on the stock exchange like any quoted company's shares. You can redeem your investment by selling your units in the fund. The share price of closed funds is determined by both the value of the fund as well as supply and demand, so it can trade at prices above or below the value of its holdings. Types of mutual funds by asset classes. Mutual funds are grouped into several kinds of categories based on the type of securities they invest in, their investment objective, and the type of return they seek. 1. Money market mutual funds. These are funds that invest only in money market instruments like treasury bills, commercial paper, and fixed deposits. The rates of these instruments will determine the performance of the funds. However, pooling funds together enables the fund manager to negotiate higher rates than investing as an individual. 2. Bond or fixed income mutual funds. These are funds that can invest in FGN and corporate bonds, more long-term assets. A portion of the fund is also invested in money market instruments. Please note that despite the fixed return on the invested instruments, the subscriber's return is based on the performance over a period and the return is not guaranteed. Both money market and fixed income mutual funds offer low return but with less risk. 3. Equity mutual funds. Investment is made in stocks based on the investment policy statements. Equity funds offer high returns but with high risk. Investing in a share of a mutual fund is different from investing in shares or stocks. Unlike stocks, investment in mutual funds shares do not give its holder any voting rights. A share of a mutual fund represents investment in different stocks or other securities instead of just one holding. 4. Dollar mutual funds. funds. These are funds that invest in dollar-denominated assets like Eurobond and US debt instruments. Some also invest in US stocks depending on the trust deed. This can help to hedge against any currency devaluation. This is also recommended for investors with dollar obligations. 5. Mixed or balanced mutual funds. These funds invest in different asset classes, which include money market instruments, bonds, and stocks. The proportion is based on the trust deed. Next week, we will continue with this topic on mutual funds, with focus on how to start investing in mutual funds, factors to consider, avoiding common pitfalls, and the advantages and disadvantages of investing in mutual funds relative to other types of investments. Thank you for listening. Please join us same time next week for another interesting and insightful session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 070-8246-3747. Stay blessed.